Practice. Okay.
Thank you so much. Now we get going.
Okay.
Yeah.
Keep talking.
All right.
But we're meeting.
Okay. Welcome to the annual joint study session of the Board of Trustees, the Financial Sustainability Committee, and the Retired Employees Healthcare Benefits Trust. Please join me in standing and reciting the Pledge of Allegiance.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. We note today's attendance. Supervisor Walsh, Clerk Brooke, myself, Trustees Barnett, Fakih, and Kalinsky are also present. Finance Director Tice and Mr. Petoskey and Ms. Emmons of the FSC are also in attendance. Also Township Attorney Dirk Beckerleg. At this time, we need to appoint a chair for today's meeting. Are there any nominations?
I would like to nominate Treasurer Shostak for the meeting chair.
Second by Supervisor Walsh. Okay, all those in favor?
Aye.
Any opposed? Okay, good. Moving on, we're on item 4, public comment. Those wishing to make public comment may do so at the podium for 3 minutes. Please state your name and address for the record.
My name is Mark Intockley. I am a Precinct 3 delegate for Bloomfield Township. I live at 1550 Georgetown Drive. Regarding the study session today, I first want to state that the full corrective action plan for the Retiree Healthcare Trust is not available on the Township website. This document right here was obtained from the Mackinac Center. The clerk's office could not locate it anywhere in the township, and it was one of the requirements that was requested by the state of Michigan. And on the document it says that the expected benefit payments will be paid into the fund plus the fixed payments of $2 million. This was back in January 15 of 2019. And when we look at the results from the other Milliman report, we see that water and sewer was paying significantly more than that requirement over the last several years, and that can be obtained also from the clerk's office. We're also told on August 28, 2023 by Mr. Theus that the Water and Sewer Fund was required to pay the actuarially determined contributions. We also find on this document that that's not true either. More than that went in over the last 6 years. Over $1 million went in from water and sewer. This adversely impacts water and sewer customers with higher fees and rates. Also impacts us because not all water and sewer customers are property owners. And garnering assets through water and sewer also appear to be a violation of Bolt versus Lansing. So hopefully those will be brought up. Also, the investment policy should be consistent with the liabilities and expected payouts. None of that information is covered. Cash flow is not covered. Cash coming in, cash going out. We have over about $29.5 million donated to the pension trust over the last 6 years. And what we were being told that it was generated by this gentleman, Brian Green, that it's cash flow generated from the trust. Well, it was a contribution. That seems kind of obfuscates what's really happening in the township and the township cash needs. Thank you for your time.
Thank you. Are there any other individuals who would like to make public comment at this time? Seeing none, we'll close public comment and move on to the remainder of our agenda. Item 5 is to approve the minutes of the Financial Sustainability Committee meeting on October 25th, 2023. They were included in today's packet. If there aren't any changes, I'd look for a motion from a member of the Financial Sustainability Committee.
So moved.
So moved by Trustee Barnett,
Support?
support by Supervisor Walsh. All those in favor?
Aye.
All opposed? Okay, those are approved. Item 6 is to approve the minutes from the Retired Employees Healthcare Benefits Trust meeting on October 25th, 2023. They were included in today's packet. If there aren't any changes, I'd look for a motion from a member of the REHBT board.
So moved.
Moved by Trustee Kolinsky.
Support.
Support by Finance Director
To
Tice.
support anything, I'm usually running these
It's
things.
just the three,
Jumping on all
of us. All those in favor of approving the minutes?
Aye.
Aye. And any opposed? Okay, that passes. Good. We're getting on to the meat of today's meeting here, which is the first on item 7. The purpose of today's joint study session is to allow the Board of Trustees, acting in their capacity of fiduciaries of township assets, to review both the investment policies that guide our decisions and the results of the investments themselves. Today also gives the board the opportunity to hear directly from the advisory committees on these subjects. So with item 7, we will consist of 3 sections. In each section, we will review the investment returns led by the investment advisor for that section, and then we will review and discuss the investment policy that governs that set of investments. As this is a study session, there will not be any voting on these policies. I will bring them to the board at a future meeting for a vote. The first section is our operating reserves. This consists of our checking account balance and those funds that are held in reserve and must be kept liquid for use in emergencies and for larger projects. We had $72.3 million in cash and cash equivalents at 12/31. We are holding about $2 million in our checking accounts, $45 million in our money market sweep account, and about $25 million in our government bond portfolio. The sweep account is a JP Morgan money market fund that is currently yielding about 5.2%. The bond portfolio is held by Fifth Third Securities and is advised by Kevin Mattaway. Kevin will walk us through the portfolio and his thoughts on our strategy going forward. Kevin.
Good morning.
Good morning.
Some handouts here I can. So a quick introduction of myself. My name is Kevin Mattaway, work at Fifth Third Securities. Been working for Fifth Third Bank for about 23 years. The last 13 years I've had a specialty in institutional investment side where I focus on assisting municipalities, school districts, community colleges with their excess operational reserves. There are, of course, Michigan Public Act rules that we have to abide by, and then further your investment policy. So I will give a quick overview on the current rate environment, some intel onto what's expected this year, go through your portfolio, and then give some thoughts on strategy for the remainder of this year as well. If we go to the next slide. One more slide up, please. Yep, there you go. U.S. Treasury yield curve. So this is the current state of the U.S. Treasury yield curve as of January 19th. As you can see, we have an inverted yield curve where short-term interest rates are higher than long-term interest rates. So that is the case up until about the 5-year mark, and then we do start seeing a little gradual raise in rates 5 years and out. But for the purpose of this conversation, we're really focusing more on the shorter end to where, inside of 5 years, the curve is inverted. Next slide, please. This is the Fed funds rate. So this is what you hear a lot of in the news as far as what the Federal Reserve and the Federal Open Market Committee is doing with short-term interest rates. As you can see, this goes back to 2015, but if you look to the right side of this graph, that is the most recent rate hike cycle that we've been experiencing since March of 22. Coming out of the COVID pandemic when rates were at 0, and then seeing steady increases in short-term Fed funds rate to 5.25 at its current level. Next slide. Go to the next slide there. And so when we're looking at, what rates are gonna do this year, the Federal Open Market Committee once a quarter supplies their economic projections. You'll see on this slide, this indicates what their projections are. In that green boxed in area on each category, there is the most recent December meeting. When you look at where we're going for the GDP, the expectation at year-end 24 is 1.4%. PCE inflation, that's the inflation gauge that the Federal Reserve is monitoring. They see that getting down to 2.4%. Unemployment rate taking up to 4.1%, and the Fed funds rate dropping down to the range of around 4.6%. The dot plot, something that you may hear people talk about and have no idea what it actually means. The dot plot is the members of the Federal Open Market Committee essentially dot out what they expect the Fed funds rate to do in the future. As you can see, pretty much all members are expecting the rates to move down further as we progress through this year and into the future. At the end of 24, the expectation is again the median expectation is around 4.6%, further dropping in 25 to 2.8%, and then to 3.6%, and then 2.8% in 26. So that's what the Federal Open Market Committee is communicating. The market is expecting actually a little more rate cuts than what the Federal Open Market Committee is putting on their dot plots. This just gives you an idea on, in general, where the market's expectation is for rates. Again, the expectation is for rates to move lower. So when we look over to Q4 24, kind of in the middle, the Bloomberg weighted average rate is expected to be right around 4.3%. So that, of course, ranges pretty dramatically by the analyst. The low expectation is for it to be around 2.75%. The high forecast is 4.75%, or excuse me, 5%.
Hey, do you want a pointer?
No, it's fine. Just the top. Gotcha. Perfect. So your current portfolio and your current holdings. So currently where we're at right now is we're invested 100% in U.S. Treasury and government agency securities. Those are both AAA rated, AA plus rated by S&P and Moody's. The strategy that we've been applying to the portfolio with how interest rates were moving higher, and the expectation was, through 22 and 23 for rates to move higher, was to stay on the shorter end and keep a laddered approach. The bond laddering essentially allows us to pick up and lock in some rates longer term, but ultimately always having that shorter maturity that we can reinvest into what was going to be higher, the expectation of higher rates. So as you can see here, if you look at the holdings, you have U.S. Treasuries, and then the Federal Home Loan Banks and Federal Home Loan Mortgage Agencies. The total portfolio, the total portfolio is roughly, 25. Let me get my eyes are. 25.6 million is the par value. The current market value and accrued interest is right around 25.3 million. The book yield currently is 4.79%. And the expectation here was we were going out roughly 1.5 years, pretty consistently as we were rolling through, but still heavily fronting the shorter end of that as well. So now with the expectation of rates falling in 2024 and moving forward, what we see as a viable strategy is to start looking further at duration, meaning locking in rates so that as rates move down, you're locked in some attractive yields at their current levels. With moving to that strategy, we would look to extend from that 1.5, 2 year range to start looking longer as well. So we would look to advise to start looking into that 2 to 5 year range. That, we would still, we'd still look to do a bond laddered approach so as not to overextend any heavily into the longer end. And then also look to move out of the daily liquid investments and start adding to the longer end as well. And Michael, did you want to hit on something?
Yeah, well, you know what, why don't you go and talk about the investment issues? We're going to be talking in a second about the investment policy for the bond portfolio. And we're proposing adding 2 new instruments to our available options, commercial paper and taxable munis. So I'll let Kevin talk about those and why they're good investments.
Thank you. Yeah, so commercial paper, so essentially Public Act 20 allows you to invest in commercial paper, which you're not currently invested in. It requires that you have invest in the 2 highest classifications, so still focusing on the lower risk, of course, part of the commercial paper market. Commercial paper is essentially, it's a short-term debt instrument of a corporation, financial institution. It's going to mature within 270 days. It's looked at as being, a lower risk option, but still able to get a higher yield than what we can get just looking in, U.S. Treasuries or agencies inside of that space. With taxable munis, so again, Michigan Public Act allows you to invest in Michigan municipalities, not any municipalities outside of Michigan, solely inside of in Michigan. The focus there is staying in investment grade, and then it's looking at the market, because of course tax exempt market is going to have yields lower than the Treasury market typically. So where we can find value is looking into the taxable muni market.
And for us, it doesn't matter that it's taxable, because as a township, we don't pay taxes. So we can pick up some extra yield there. Any questions for Kevin on anything he went over?
I have a question. On slide 7, the dot plot, I was just curious, has anyone ever looked backwards after to see like how close these projections are, how reliable, or have you ever done that?
Yeah, in the recent history, it does not look great, right? I mean, when we looked at going into 22, the Fed through the dot plots were expecting a very slow increase to interest rates. So when you looked at those dot plots out, you would maybe see it get into that 2.5%, 3% range. Well, of course, we're at 5.25 now, right? So it is not, looked at as being a certainty by any means, but I think what it does allow us to understand is just what the mindset is of the Federal Reserve and what the expectation, at least on the direction of rates. And then of course you have to still apply your own knowledge to that as well, right? And good question.
Anybody else with any other questions or comments? So I think just to reinforce one of the points that Kevin made, that as we are now forecasting, you've seen this dot plot rates coming down, we want to move money out of our money market funds, which are very liquid, very short-term duration type of funds, because those rates are going to fall quickly as soon as the Fed starts lowering interest rates, and locking in some yield on Treasury securities or commercial paper is not long-term enough, but or munis or agencies that allow us to lock in a rate for a longer period of time. So if you look at the portfolio page again, which is page 10, you'll see that, for example, we have 2 treasuries maturing. One is February 29th of this year, and one is March 31st. That's the second and third row. And together, that's about $7 million that are going to come due. So that the bond is maturing. We're going to, wake up on April 1st rather, and we're going to have $7 million in cash sitting in our account. And we're going to look to push that out beyond 25 or even into 26 to lock in that rate for as long as we can. So, as rates are coming down, we're going to try to lock in these yields for a longer period of time. So you saw the last one that we just bought was the one on the bottom row for August of 2026 with the yield of 4.46. So that we're going to earn 4.46 over the course of the next 2 years. And we're locking that in for 2 years. So it's still a highly liquid security if we ever needed to sell it, but we're going to be into locking that in. So we're going to take, the $7 million that we're going to get over the next 2 months, and we're going to invest it probably something we're going to be looking at later in 26, maybe even in 27, to see where the best balance of, high yield and liquidity is. So, and we may at some point move some of the money that we just moved into MI class into this portfolio, again, to lock in longer term rates, because as the rates start to come down, those money market funds are just going to drop, quickly. Those change every day, rather. So, so any questions?
What's the cost to purchase these?
Yeah, about 3 to 5 basis points.
Okay.
Just for clarity, that's both the commercial paper and the tax and municipal bonds?
That'd be everything that we buy.
Everything, okay.
We don't have to pay when it matures. So we pay when we buy it. And if we were to sell it before it matured, we would pay the same 3 to 5 basis points. But for now, we've pretty much been holding everything until maturity. So, as I said, we're going to wake up on April 1st, and there's going to be $7 million in our account, which is going to be earning in the top row, because that's our money market account. So we may not rush into buying something because we're going to be earning 5.2% on it on a daily rate. But at some point, before, looking at the dot plot again, they're saying at some point in 2024, we're going to start to see rate cuts. So whether it's Q2 or Q3, we're going to start to see, again, expectations are that we're going to see some rate cuts, and we're going to want to start locking in things for a longer period of time. Okay, any other questions for Kevin? Okay. So the next item is to look at the general investment policy, which is in your packet. This is the policy that governs the investment of funds for in the short term, our reserves, and these policies are guided by Public Act 20, which is the state law that guides how municipalities can invest their reserves. So in the packet, I've included a proposed policy, which basically the only difference between what it currently is and what I'm proposing is that we add commercial paper and Michigan municipal bonds as authorized investments. And basically the way we're doing that is we're saying in the policy, it says in section 5 that, we are authorized to buy anything that is authorized by state law, which is Public Act 20. Dirk has reviewed the policy for legal matters and is okay with it. And so I'd be happy to take any questions now from people about the investment policy for the operating reserves.
So just since I didn't see the red line version, so it's just this section 5 that's changed right here?
Yes.
Michael, I have a question.
Yeah.
Do you know of any other municipalities that are currently investing in commercial paper and or municipal taxable bonds?
Yes, several. Commerce does. And basically, they write their investment policy the same way I wrote it here, which is we are allowed to invest in anything that state law says we're allowed to invest in. So if Public Act 20 were to get changed by the state legislature, our policy would still conform to whatever as amended.
Correct. So it provides us more flexibility, but also at the state law, then we'll always be conforming.
Yes, we would always be conforming to state law.
Perfect.
And the idea is just to have, different types of arrows in the quiver based on what can generate the best return, and at the same time, still being highly liquid and safe, which is the point of Public Act 20. Again, we're not going to vote on anything now, but I'm happy to discuss it if anyone wants to get into it.
Quick question. Is
Sure.
there anything in here concerning what percentages of different types of?
No, Public Act 20 does not provide for any allocation of assets. And this, again, only applies to our cash operating reserves. So this doesn't apply to pension or anything like that. This is strictly, we've got money in our checking account, and then we've got other money that they call, the state law calls operating surplus. And, the name of the act is the Surplus Funds Investment Act or something like that. So anything that we determine we don't need, like, when Jason and I talk about, okay, this week we've got to pay payroll, this week you got to pay, X, Y, and Z. So we need to have this amount of cash in our bank account. The rest of that is considered surplus that we could invest in. Again, it's still got to be invested in safe and liquid securities. And that's why it's strictly limited to fixed income, treasury bills, agencies, commercial paper, municipal bonds, strictly fixed income and highly liquid.
Right.
Highest investment grade.
And the allocation topic we should discuss, that's not changing here. There was no allocation in the policy before, there's no allocation.
No, there's no, yeah, I mean, it's very limited as to what we can invest in.
Right,
It's very limited to what we can invest in, and there's no allocation amongst, you gotta have X amount of treasuries and X amount of this. No, it's anything that's covered by the act, which is very, very limited in scope, is authorized.
So theoretically, 100% could be commercial paper, or 100% could be the municipal bonds at the discretion of the treasurer.
Yeah. I mean, commercial paper is very limited in duration. It's 270 days. And so what that means is that as rates come down, they're gonna come down as well because they're very short term. They're always turning over. So I don't expect now that we're going into a declining rate environment to actually buy any commercial paper. But the other thing to keep in mind is that MI class does invest in a lot of commercial paper. And so even though we've already approved MI class as an authorized investment vehicle, by allowing us to invest in anything that's PA 20 compliant would mean that anything that MI class can invest in, we can invest in. And MI class are professional managers, they're active managers, they're constantly looking at the companies that they're buying into. I don't have time for that, so I don't anticipate that we're going to do any of that. I just want to have that arrow in the quiver if a good opportunity comes up that for short-term investment.
Great, makes sense.
Okay.
Thank you.
Any other thoughts, questions, concerns?
I would get out further because it is going to come down.
Okay.
And that money market's going to go quickly. You're not going to be able to react quick enough. I mean, with liquidity in there, so going out into 27, 28, if you've got that flexibility,
Okay.
would it make sense? My question.
Sure. That's why you're here. Yeah. Okay. So when
Good news. You're thinking that actually the rates are going to keep on going down more and more. I love hearing that. So, who knows, right? But here's someone who
Good for
knows.
loans, bad for investments.
I don't feel they're going to go up. So
Right.
let's just say
It's a
Great
good,
for loans.
as
Right.
Danny said, it's great if you're a borrower, not so great if you're an investor. So I mean, to Dave's point, again, when those two bonds mature this month, or not this month, we're still in January, at the end of February and the end of March, that's $7 million. I'm going to be talking to Kevin, and we're going to be looking at buying something into 27 or 28. And the good thing is that yes, even though it's 4 years into the future, because they're treasuries or agencies, they're highly liquid. So if we needed to sell it, we could do it like that.
maybe talk to.
We're not going to get stuck in any.
Maybe talk to Kevin on what a discount would be if you had to, so you can make sure you're informed.
Right. And that's the trade-off between how much is in the coupon versus, right? So, yes.
Just as a point of reference for the Board of Trustees, is that you can decide, you can amend the investment policy to limit the amount of, for example, if you're not comfortable with a lot of commercial paper, you can actually put in the investment policy, we only want X percent, whatever that number is, 5%, 10%, 50%. Yeah, but you have that, you can do that if you'd like to.
Yeah.
We do that in some of the others, like with real estate and things where
and
we want to make sure.
No, 100%. I mean, we could limit it to Raina's point.
Yeah.
And because we're going into a decline rate environment, I don't think that commercial paper is going to make a lot of sense right now. But because we're modifying the investment policy, I'm looking at down the line when we eventually go back up into an interest rate environment that's going up. We want to be able to get into short-term securities. But sure, the board could dictate, say, okay, we don't want, more than 10% of the portfolio in commercial paper. What was I just going to say? But the municipals are really more interesting. And the other thing is that the way the investment policy reads, it's whatever is allowed by PA 20 is what's allowed for us to invest in, which is how a lot of municipalities have their investment policy. But obviously, if the board wants to limit it, we can do that.
Personally, as somebody who doesn't know as much about investments, I'm very happy that Michael, you and Mr. Owens are all here to guide us. Like you said, you guys are the experts, so we're thankful that you're here.
Great. Any other comments on that? want to be mindful of time and keep us moving forward, but I do want to allow for discussion if there's anybody that wants to address anything. Okay, then we'll move forward. Thank you, Kevin. Let's turn our attention to the second category of investments, which is our defined benefit pension trust and our retired employees healthcare benefits trust. These trusts are advised by Brian Green and Mike Holycross of Anco Consulting. Looking at the pension trust first, this trust consists of the Empower Guaranteed Deposit Account, which is managed solely by Empower, formerly Prudential, and we have no control over the investments or the returns. This is a contract, for reference sake, that was signed. I actually found the original contract the other day. It was signed in 1960 by Homer Case. Okay, and that contract is still biting us to this day. And so the GDA represents 57% of our total pension trust, or $128.7 million. Then we have a portfolio of equities of $90.7 million, or about 40% of total trust assets. And we also hold limited partnership interests in 2 real estate funds of about $6.7 million, or 3% of the trust. So in essence, Brian advises us just on that 43% of trust assets that are not in the GDA. And our retiree healthcare portfolio of roughly $25 million, which is completely within our discretion, is also advised by Brian and Anco. So Brian's going to walk us through these portfolios, talk about last year's returns, and we also have with us David Sowerby, who manages one of our stock portfolios in both of the trusts, the retiree healthcare and the pension, who will talk to us about his strategy. So, Brian.
Perfect. Thank you. Apologize in advance if my voice goes out. This has been a week of a lot of yelling, either at TVs for the Lions game, or my oldest is in the midst of district playoffs for hockey. So there was a lot of yelling the last couple of nights. My kid can't hear me, so it's great. I'm going to start with last year was absolutely fabulous from an investment standpoint, but to Jason's question around I thought it was a perfect setup. Fed dot plot. Do we ever look back and see where we right? Mm-hmm. So this is the time of year we always talk about predictions, like what's the stock market going to do this year? What's the stock market? Where's the S&P 500 going to be? So this actually came out January 2nd. It's just one of the news aggregator emails that I follow. 20 different Wall Street firms and their predictions on what the S&P 500 was going to do for 2023. Now the actual return was 26%, right? It was beyond, I think, anybody's expectations. The range of forecasted returns for calendar year 2023 was a -4 to a +19. So 20 different, very well-respected Wall Street firms and research houses, their forecast for 2023 was -4 to +19, and the actual result was +26. So in terms of expectations for what we think is going to happen this year, I can honestly say I have no idea. I can just tell you what happened last year and say, because the expectations are so wildly different, this is why we have a diversified portfolio and own a little bit of a lot of different things. To take in overall market results, first thing I'll have you focus on, this is on the first page in the presentation, again, that focus on diversification. So as I mentioned, the S&P is up 26% last year. I always think this is fascinating. Obviously, that was driven by 7 names, the Magnificent Seven. We've gone from the FANG stocks to Fat Man to now we call it the Magnificent Seven in terms of just driving performance. But if you look in the bottom, if you try to look at it on screen, the text is too small, but on your page, the bar charts on the bottom measure the sector returns. So 500 stocks in the S&P 500, but it's broken out across 11 different sectors. And I always think this divergence in returns is fascinating. If we go back to calendar year 22, that would be the bottom right-hand corner of the page. The S&P was down 18% 2 years ago. I was going to say last year, but this is 2024. 2 years ago, the S&P was down 18%. The 3 worst performing sectors in calendar year 22 was information technology, consumer discretionary, and communication services. Think growth, growth, and growth. Calendar year 22 was a period of rising interest rates. The 3 best performing sectors were energy, utilities, and consumer staples. Fast forward, get through 2023, S&P is up 26.3%. The 3 best performing sectors, any guesses? Information technology, communication services, consumer discretionary. The 3 worst from 22 were the 3 best for 23. 3 worst performing sectors in 23, energy, utilities, consumer staples. So what was last is first, what was first is last. Again, this is why we own a diversified portfolio and have a number of different asset classes included. Flipping forward to page 3, I always think this is the great long-term test. The decision, Kevin was in talking about Public Act 20. Public Act 20 is for municipal cash. Public Act 314 is for long-term assets. So the investment limitations are much, much broader, right? We can own stocks, we can own bonds, we can own real estate, we can own private equity, we can own asset classes that may generate a negative return this year and might generate a positive return next year. And it's because we're long-term investors, right? These are assets that are going to be paying benefits 50, 60, 70, 80 years from now, if you think about it from a long-term standpoint. So back in April of 14, portfolio was worth $84 million. We have had net negative cash flow out of the equity portfolio. So these are assets moving over to the guaranteed account at now Empower. $41 million in net negative cash flow. So the market has added $54.6 million in market value for us to be where we are today at $97.4 million. If you think about it, if those assets were invested in Public Act 20 type investments or fixed income investments, that return would be closer to 0 over the last coming on 10 years. So that wouldn't be $97 million in market value, that would be $42 million in market value today. That's been the differential. If you think about last year and say, hey, if I would have just had this invested in treasuries, right? Last year was a good year from a fixed income standpoint. We might have generated, say, a 5 or 6% return in calendar year 23. The overall equity portfolio generated a 17% return. So that, embracing risk in the portfolio and having that long-term focus in calendar year 23 was about an $8 million addition to the value of the portfolio by having equity exposure versus just being in strict fixed income. So again, that intelligent use of risk in the portfolio has been extremely additive. Flip ahead to page 4, talk about overall results. So a couple different features. Save for the fourth quarter, calendar year 23 probably wasn't going to be nearly as successful as many thought. And it was really November and December. I always think about the Santa Claus rally. I always make that joke when I walk into client meetings in late November and early December. Like, if your kids are writing a letter to Santa Claus, just include hey, give me a little bit more on the S&P 500 or on the Dow. So for the quarter, up just over 10%, in line with benchmark and peers. On a fiscal year-to-date basis, so this would be 9 months into the fiscal year, right, Jason, March 31?
Yes.
Okay. So 9 months in, about a 10.6% return. And for the calendar year, as I'd mentioned, generating a 17.6% return. So strong performance across the board. As expected, it was a good year for the equity markets, and with 90+% of this portfolio being invested in U.S. and international equity markets, it's going to be a great year. Just a couple of notes from a strong performance or weak performance standpoint. I'll skip Ancora. David's going to be up in a minute to talk about it. Edgewood, growth lagged in calendar year 22, but the Edgewood portfolio, I'll apologize, was only up 39.7% for the calendar year versus their benchmark that was up 42. They're underweight Apple, they're underweight Microsoft, they're underweight some of the bigger names, but some big drivers for them were Netflix, which I only mentioned this because it was in the news this morning, just signed the rights to WWE from a distribution standpoint. Intuit and Lulu. Clarkston struggled. We did, at the end of the year, we were so excited to add something new to the portfolio. Then this book, Reinhardt, is listed twice. But working with Michael and looking at the current allocation we had within the small mid-cap portion, it was a 50-50 split between Clarkston and the Fidelity Extended Market Index Fund, which essentially is the U.S. stock market, kick out the 500 names in the S&P 500 and own everything else. So it's by and large is a replica of kind of small mid-cap stocks, but just wanted some more diversification, just given Clarkston's pretty large performance swings. So we added the Reinhardt portfolio, which is a small mid-cap, 35 to 40 names. One of the hallmarks of their process is when they generate when they're looking at companies and doing research on companies and develop a price target, they actually use private transactions. So rather than using some kind of discounted cash flow model, is they go out and look at actual transactions where other publicly traded companies in that industry were taken private, either bought by a larger peer or bought by a private equity company, and use those transactions to assign a price target to the company. So it's what somebody, think about it like this, like, I think I know what my house is worth, but if the house next to me is for sale, what that sale price is what my house is worth, right? So using an actual live transaction rather than a forecast of what I think this given company is worth. So now the small mid-cap portfolio that was 50-50 Clarkston and Fidelity is now a third, a third, a third. So just some broader diversification within the small cap allocation. From an international standpoint, positive news across the board. Oakmark lagged a little bit for the quarter. Longer term results continue to be strong for them. Biggest impact for them was actually Ryanair in the fourth quarter. And then JP Morgan, from an emerging market standpoint, outperformed for the quarter given their overweight to Taiwan Semiconductor. And then real estate continues to be a laggard. You know, the impact of rising interest rates. Principal's done a really, really good job managing through all of that. TerraCap still in positive territory. We actually expect to see continued distribution activity from that TerraCap portfolio. And then finally, just a little bit from a residual cash standpoint. So we have a little bit more to talk about later on the agenda, just around the investment policy statement and kind of expanding some opportunities there. I wanted to pause there and take any questions.
With the expected interest rates going down later in the year, do you expect that the real estate portfolio will show more of a swing in a positive direction?
So the funny comment, there's always spin everywhere, right? But the comment consistently from a real estate standpoint is survive until 25. So Principal's done a really good job managing through it. TerraCap should actually even be in better shape. Conversation with Steve Hagenbuckles, he's the kind of the lead manager there, is that, you know, any of the debt they have in the portfolio obviously has become more expensive. But for them and the way they built the portfolio, the rental growth, like, right? We bought the property and the 2-bedroom apartment was leasing for $1,500 a month, and market rate is $1,800. So we were able to raise rents. Is the increase they've had from a rental income standpoint has more than outpaced any additional costs. And that's been consistent in Principal as well. So they've been able to kind of weather that storm of rising interest rates. But any decline in rates, you're going to see, it's going to take a couple quarters just because it's kind of a lagging indicator. But that would be a positive from a real estate standpoint.
Brian, you know what might be helpful on the real estate is having like maybe Vanguard's real estate public fund, because that would be down 20%.
Yeah.
22 or 23. They come back quicker because it's public, we can trade it, but at least we got something to compare it to.
Yeah, we can have that. It's a great idea. Thank you, Dave.
I'm not saying to use that one, but something like it.
Can I use an office REIT index fund?
Can I get 5 extra points for the Lions?
Any other questions right now for Brian?
Actually, I just wanted to point out, I appreciate the comment specifically about what if we were to change our investment policy at the beginning of the year, going to like a fixed income or following that positive trend of a 5.5% fixed income. People have suggested at times that we would go to a more fixed income style plan and not worry about the market trends. If we do that, though, we miss out on $8 million. Yeah. So that's the reason we have a diverse portfolio, and that's the reason we continue to weather these storms and not just follow the trends, but do long-term solutions, not just a flash in the pan type of things. So I appreciate you bringing that up. Thank you.
Thanks, Chris.
Ready for David?
Yeah.
Okay. And then Brian will come back after David comes up here.
You want to talk about something?
So just for reference, David is with Ancora and manages our dividend value portfolio.
How are you?
Local.
Hello, thank you.
3 miles.
3 miles.
That.
Thank you.
You don't get much more local than that.
No.
most important message today is thank you, right? In November 2019, you funded the strategy. It's been a good outcome. Rule of thumb is always in this industry. Never think you're smarter than you are. Never look too long at your performance numbers. Markets have a profound way of humbling when portfolio managers are a nickel who think they're a quarter, if we put it that way. I'll cover most of the time on the portfolio itself and where it's positioned today, and very little on the markets. But when I talk about the markets, the most important thing to you is I'll bring it back to your portfolio and expectations. So Michael asked me just to give you a brief background on Ancora, Bloomfield Hills and Cleveland. So obviously very Midwest. We work with roughly 20 Michigan public funds. But probably the most important thing for our clients is we manage about 4 different stock strategies and about 4 different bond strategies. And this falls under the category of don't think you're smarter than you are, but 4 stock strategies, 4 bond strategies. If you look at the strategies in aggregate, 1 year, 3 year, 5 year, 10 year, over those time periods, both on the stock side and the bond side, every one of our strategies has outperformed its index in all those time periods. When I look at my peers, that sits in pretty good stead, given the rule of thumb is how many managers outperform their index, but every one of our strategies has over short-term, intermediate, and long-term strategies. If you go to page 3 of the book, this just gives you at year end the value of the respective pools of money that are managed in this value strategy. So you'll see that it stands at $15.7 million in aggregate. If you go to page 4, performance, the rule of thumb on the 4+ years that I've had the opportunity to manage your portfolio is what I'm really looking for is consistency. Consistency of outperforming my peers and the index. And that's been the case. So if you look at the since inception, the portfolio has a compound annualized return of 10.7%. My value index that Brian uses 7.8%, so it's compounded above the index. And if you think of that 4-year time period, you had 2 bear markets, COVID 2020, as Brian pointed out, 2022. We've had some bear market or some bull markets along the way. It's been to the good, right? 10.7% annualized rate of return, but we've had headwinds and tailwinds, and you've held in better in down markets, and you've outperformed well in up markets, and that's the key. So as your value manager, my duty is stay in my space. Value, as Brian has heard me say too many times, is a way of life, right? You're the value manager. You buy your suits, your cars on sale. You buy 2-year-old cars. You buy stocks that are discounted. You don't want to overpay. And knowing a little bit about your growth manager, having actually on committees hired him 3 times in my career, I think we're a good complement. So in your value portfolio, we own 30 stocks. So it's like the Edgewood portfolio, it's more concentrated. I'm an active manager. You will never see me come into this room with 50 or 60 stocks in the large cap space. If you're active, be active, but still have a diversified portfolio that's going to fare well in up and down markets. So as your value manager, I want to buy things on sale. And in particular, I want to buy stocks that are discounted 20 to as much as 30% to the overall market. But sometimes cheap stock stays cheap and they test your patience. So what I'm going to look for is companies that are also very good at allocating capital in the interest of you, the shareholder. And by way of that, I want to really look at their cash flow, a little more granular, their free cash flow. Am I getting a stock that on a free cash flow basis is discounted to the market, but is still growing the free cash flow and has an attractive free cash flow margin? And then with a dividend focus, what I'm really looking for is companies who are growing the dividend. So my yield today in the portfolio is about 2.4%. That's reasonably attractive. But what I'm really looking for is companies that are growing the dividend, returning it to you, the shareholder, more than 10%. So 30 stocks at the end of the day. It's been a little more challenging, obviously, to the value manager relative to the growth manager. Always beware of managers who come in and talk their book. If it's value, it's going to be a great value market. If it's real estate, it's going to be a great real estate market. I do think the empirical evidence does say, and I'll get to it quickly, there's probably going to be a little bit better tailwind for the manager who pays greater heed to valuation. So if I pick up the pace here a little bit and I talk about page 5, which is the portfolio today. So 2023, I won't spend much time on it. One of the big events I can tell you for a value type investor was March of 2023 when the SVB filing took place. It was over the weekend, and the Monday before, we had no inside baseball, we had no extra intelligence. We cut your bank stock weighting significantly before the filing. We subsequently, you had 3 bank stocks, Citizens Financial, B of A, and JP Morgan. Quickly after, we sold Citizens Financial, opting to keep JP Morgan, which has been obviously the very good bank, and Bank of America, which is held in reasonably well. That speaks to one end of the spectrum. The other end of the spectrum is we have a good weighting in technology, but my tech stocks trade at a little more discount, or a lot more discount than, say, the growthier parts of the market. Now, your largest position has been Broadcom, which is a semiconductor name, but they also are in software, right? They bought VMware, they bought Symantec, they bought Computer Associates. Twice in 2023, I did what the value manager is supposed to do. I trimmed it on price appreciation. So Brian correctly referred to the Magnificent Seven. I would say editorially, I'd call it the Elite Eight, and throw Broadcom in that category. And not to make this a Broadcom versus NVIDIA debate. NVIDIA's been a fantastic stock, but in the last 2 years, I looked it up this morning, Broadcom has compounded in the last 2 years 55% to you. NVIDIA, great stock, a little too expensive for my taste. It's compounded at 60%, so a pretty good vote, and I did the right thing. I think it's still your largest position, but I cut it back twice last year. We own Apple and Microsoft. We continue to cut them back. They keep going up. But in my case, on a free cash flow basis, I think there's still value in both those names. A little more boring, we sold our Nestle. We added to Kenvue. That's a spin out of J&J, Listerine, Tylenol, Avedo, cough and cold medication. More recently, added in the consumer staple space, seeing some value there. Kellanova is the spin out of Kellogg's, Pringles, Cheez-Its, Pop-Tarts, not the cold cereal, which is the no growth. It's the salty snacks that people still crave, even in this Ozempic crazed world. People will give up sugar, but they won't give up their salty snacks. More recently, we added American Tower, which is think of it as the hotel that houses the wireless radio, TV. We bought the stock when we thought it was a lot cheaper and a better entry point, and they were shedding their unprofitable India business. The stock had fallen from 300 to about 180. We bought it a little below 200, thinking we'd get a better entry point, and they're cleaning up some of their international challenges. So at the end of the day, it's going to be 30 stocks, discounted valuation. There's no silver bullet, but pay great heed to the free cash that the company's generating. And are they growing the dividend? They got free cash, and what are they doing with it? You can buy back shares, you can buy a company, you can hire people, you can build a plant. My favorite is when they increase the dividend and give it back to shareholders. Page 6, I won't spend much time. This just gives you a view on the portfolio from 30,000 feet. So consistent with the commentary, better dividend growth for your portfolio, a little higher price to earnings ratio, but more important to me is on a valuation basis, your free cash flow yield, how much free cash is the company generating to its size is better free cash flow margin, better return on capital, and you'll see your top 10 holdings, Broadcom 7% of the portfolio, but again, gave it 2 really good haircuts last year. Briefly on the market, the discussion was, what's the market going to do this year? Flip a coin. The rule of thumb is usually it's better than 13% or less than 7%. It's never in that 10% sweet spot, like the long term. The one thing you always got to think about on page 7 is, if you look at the last 30 plus years, the average intra-year decline is about 14%. Yet the market goes up 2/3 of the time. You always have to be ready that sometime during the calendar year, intra-year, you're going to get a little gut check. For your portfolio manager, just means, what can I buy today that I couldn't buy before because I thought it was too expensive? Page 8 is a lot of talk about corporate profits. I care more about what's going to be the growth rate in free cash flow and the dividend, and that's a lot more consistent than the volatility of earnings per share or net income. And that's expected to continue to do very well in 2024. Page 9, I think, is probably the most important macro chart to bring it back to your portfolio. It might be the most granular, but here's the key. The next year, right, flip a coin. The next 3 to 5 years, you have a better feel for, what am I paying for the company today, and what do I think its expected return is going to be on a 3-year to 5-year increment. And when we're buying companies, we're thinking about at least a 3-year horizon for, does this company create shareholder wealth? So if you look at the red line to all the dots, it just says that the S&P 500 today has a free cash flow yield of 4.3%. That would equate to an annualized rate of return of about 6.3%. Now, very biased, my free cash flow yield is a little higher. That equates to about an 8.2% price return annualized in the portfolio you have today. If I throw in the dividend yield on top of that, you feel like you've got a reasonable good chance of a 10% annualized rate of return over the next 3 to 5 years, with the usual disclaimer. Nobody knows, as Brian so well said, what the next calendar year holds. And as the value manager, promising not to talk my book, I think the backdrop is a little better given the valuation I'm paying today and the cash flow the company's generating and the growth in the dividend, that you've got a good opportunity that this will do well as it has done. And I'll just say with a little smile, you said you had $7 million in cash maturing in March, destined for the bond market. Maybe save a little bit and think about if you can get a little more opportunity talking my book blatantly in the equity market. I'll stop there under the spirit of nobody boos you for a short presentation and see if there's any questions. And again, thank you.
Any questions, David? So one thing I want to address is in your pages 10 and 11, that shows the portfolio. This is all of our combined portfolios.
Yes, it is.
Right, and so this is gonna dovetail nicely into our next topic, which is the RHC trust, the Retiree Healthcare Trust, that this portfolio that you're showing here is really spread across 6 accounts.
Yes, it is. They're all managed identically.
They're all managed identically, but it is 6 separate accounts.
Yes, it
And
is.
so this is the total share count for each one, in aggregate of those portfolios.
Yes, in the spirit of saving paper, I
Right.
combined.
I appreciate that, and that's going to, like I said, dovetail nicely into the next topic, which is about consolidating the accounts, and the potential pros and cons of that. It's specific to the RHC trust. So, any other questions for David on the Ancora strategy?
I'm going to just thank you. I think you've provided outstanding value to the township, and we're very fortunate to have your expertise.
Likewise, I mean, it's a wonderful opportunity, and the whole mission is as I said, don't look too long at your performance. Keep your head down and keep your eye on the ball. That's got to be the key. I've seen too many managers who think they're too smart.
Best outlook.
One more quick question for you, Ryan.
Sure.
And echoing what Neil said, what's the sort of, you mentioned you're sticking with, and I can see in here 30 stocks. Can you talk a little bit about, and maybe a little more, because you did put it on the recent trends, but the turnover, like what's in there, are the same 30 stock kind of in there today as were 10 years ago, or when you started 3-4 years ago, or how much of it is like turned over?
Sure, the annualized turnover is less than 20%, which means we're trying to find companies we can own for 3 to 5 years. Last year there were 4 buys and 3 sells, which fits into that. And to be brief, the whole premise is patient capital wins. There are great managers who can have higher turnover, and if they have a great mousetrap, that's good. I'm just under the belief that patient capital wins with what you're buying. Are they good allocators of capital for you, the shareholder? So there's names in there that have been there from the very beginning. Home Depot, McDonald's, looking at the list, Procter & Gamble reported yesterday, JP Morgan, and there have been names that are more recent, like the Kenvue, Kellanova, General Dynamics reported this morning. Those are more recent ads.
Thank you.
All right, thank you, David.
Thank you.
Let's move on. So I want to now move to Roman numeral 2 in that section, which is the consolidation of the RHC Trust sub-accounts. And for everyone, we're losing members here left and right. We got to keep moving here. So yeah. Do you need more water?
No, I said I think it's
Here,
all water.
I haven't opened it.
Oh, here.
All right.
Okay, so so this requires some history.
I have unopened.
The Retired Employees Healthcare Benefits Trust was created by the board in 2005. At that time, the trust had one account that invested the trust's funds. The trust was modified in 2015, so 10 years later, to allow for sub-accounts within the trust for each separate department, starting with the Water and Sewer Department. It was felt at that time by some that because the Water and Sewer Department was funded by ratepayers and not taxpayers, that department should have those contributions separated from the general employees' contributions. This was followed by sub-accounts for cable, building, and public safety. I questioned this policy as a trustee, but when I came into this office, I began looking into this matter more. We don't have sub-accounts in our pension trust for different departments. Why would we need to do that for the Retiree Healthcare Trust? Other nearby municipalities who have OPEB trusts don't use sub-accounts either. So upon review of the relevant statutes and discussion with our legal and financial advisors, I'm convinced that it is entirely unnecessary to have multiple sub-accounts. Why not just leave it? Well, there are efficiencies that can be gained by keeping all investments in one account, and these efficiencies save us time and money. In addition, because each sub-account is its own distinct investment account, like you saw in the last presentation, that we have 5 different RHC portfolios, we have less money in each account, and that hinders us from buying certain classes of shares, which can help with overall diversification, and also prevents us from getting into certain asset classes. So in your packet is a resolution that I would like to bring to the board for approval, and I'm opening it up for conversation now, and Dirk is here and Brian Green are here to talk about available questions, and this is about consolidating the retiree healthcare trust from 5 separate sub-accounts into one account. So that was in your packet, and that's under the section labeled item 7A, Roman numeral 2. It's that resolution. So are there any questions, comments? Yeah, Rena.
I'll start that off. Our firm, we represent over 40 municipalities in southeastern Michigan. No one does this. No one doesn't have sub-accounts, just to give you some background. It's not a common thing. So, from an advisory standpoint, I fully support you trying to condense it, combine it, and like you said, it's much more efficient to have one.
Thank you. Any other questions, comments?
Simplicity is better.
City's better. Okay.
Cost efficient, time efficient.
I've had the opportunity to review what you submitted, and I think now's the time to consolidate it.
Okay. Any questions for Dirk? I asked him to be here.
Are there any downsides to it?
No, I don't think so. It's perfect. We reviewed all the relevant acts. I reviewed the trust document itself. The trust document indicates that if the township decides.
Should we have you come up to the? Yeah, either there or there.
You know, if you can add to why it went to be broken out as well.
Yeah.
You know, like why did we start breaking them out, or was it that way?
I can't offer that information. I don't know why. I was not here then.
So I said in my comments there that it was felt by some in 2015 that to deposit funds that had been withheld from that we were making out of the water and sewer fund, that it should have a distinct sub-account because that's from ratepayer funded revenues versus taxpayer funded revenues. And so once that was done, then the natural follow-up after that was, well, building is the same, is revenue, is not taxable revenue, is not tax funded revenue, and cable is not tax funded revenue, and public safety is a separate tax than the general tax. So all these accounts were added, and the handcuffs that it provides for our investment advisors to be able to, like you heard David, he has to manage 5 different portfolios that he does exactly the same way. Sure. And as you know, that when we have larger dollars that we can invest, we can get different classes of shares and all that.
I support all that. I just want to make sure from a transparency standpoint, you don't create more work, right? If you have people that start digging into that, but it sounds clear to me.
Yeah, okay.
Just, again, I don't have any skin in the game as far as the vote. I'm just making sure.
Reviewing Dirk Beckerle, Township Attorney, reviewing previous records, it appeared that there was some concern on some board members' part that if you didn't have sub-accounts, maybe there was a violation of the Headley Amendment because you were mixing enterprise funds with funds that were raised by taxes. That's clearly not correct. There's no Headley violation if you consolidate all these funds, whether they're enterprise funds or funds from tax-based revenues.
And those heavily concerned individuals are no longer part of the board, so.
That's right. And the Public Employee Health Care Fund Investment Act, MCL 38.1140B, supports consolidating them into one. Section 3.7 of the Retiree Health Care Trust as amended provides that if the township decides, then you have to do sub-accounts, but you can also undo that. So there's authorization both by the trust itself as well as state law that would authorize and allow the consolidation of those accounts.
So your question was, are there any downsides?
So yeah, one of the downsides is exactly what you're talking about, transparency, knowing that those people who were involved were also involved in a lawsuit that cost us as residents over $1 million to fight. You're saying legally, even with that lawsuit and everything showing, it would not ever allow them to come, well, they could sue us for anything,
people do
we
sue
would
for
have a
anything.
good leg to stand on that this is, as you mentioned, not common, and you also mentioned the simplicity, and with Michael's, that the fear is really what was based behind that lawsuit.
I think that's right. I think from a legal standpoint, you're perfectly okay. It looks like Brian wants to say.
I think there's an important clarification. This is consolidation for investment purposes only. like, it's still accounted for and tracked. Like, we can tell you what the water and sewer balance is. You
Okay.
can tell you what the public safety balance is. Because every other, she said 40, and like, my 30 is less than 40. But like, I have 30 different retiree healthcare plans that we work with in the state of Michigan. You're the only one that has it segregated. But, you know, I was in Shelby Township on Monday, and their OPEB plan, we can tell you what public safety and cable and water and so like all of the subcomponents are, the court, like all of that can be, this is an investment consolidation, not an accounting consolidation.
That's correct. You'll still know
Right.
the allocation, if you will. But
Right, and another point that I'd like to make is that, and it's in the resolution, is that the liabilities to pay those benefits is the township's liability. Whether or not it's funded, or what level it's funded, or how it's funded is kind of beside the point. The issue is, we promise healthcare to people. We are on the hook for that, to everybody, whether they're in public safety or their library or anyone that's part of our plan. We have that liability. But this allows us to invest the trust assets that we're putting in there in a much more efficient and cost-effective way.
there's really no downside.
I do like that investment consolidation, not accounting consolidation, so that helps.
Yeah, so it's still fully transparent.
Yes. Yeah.
I like that.
I'll just add that I spoke to our auditors and our actuary, and there's no issue. There'll be some adjustments on the actuarial side as far as making sure they get what they need and I get what I need for fiscal year end, but no issues from either of those.
One quick question. It's been said that it's efficient and cost effective, but can we quantify that? I mean, what will we save if we go with a consolidated investment approach versus separate ones?
Brian, I don't know that it affects your fees per se, because you're just a general fee over all of our investments. But I guess the biggest one I would say is that, in order to get institutional shares of a mutual fund, you have to have a certain minimum threshold, right? And so that has a lower fee structure than if we bought retail shares, right? And so can I quantify it? I mean, I guess we could look through our portfolio and figure out which ones we'd be able to get different classes of shares. Are we talking about millions of dollars? No, we're not talking about millions of dollars, but there's also
the fees of
the fees would be the dollars and the time.
The same.
Yeah.
But there's opportunities that were lost potentially.
I would say there's the potential for opportunity lost that you didn't have availability because your portfolio wasn't big enough to allocate to that. And so when you aggregate it, you have a little bit broader diversification and opportunities.
Opportunities to make a better return on investment.
Okay, it's an opportunity cost issue.
Yeah, and to connect this to the next topic of discussion, which is going to be different asset classes, having 5 different portfolios for retiree healthcare and to the size that they're in, we've only got a $25 million portfolio right now, and so if we split 5 ways, it's not even, then that would limit us to be able to diversify into some of these other asset classes that we're about to talk about.
Right. So the smaller ones end up driving the bigger ones because they're all equally invested. The bigger one might be able to get a better investment, but it's dragged down by the smaller account because then they wouldn't be equal.
Yeah, and the benefit is that
makes sense.
How we allocate the funds that go in, again, is kind of irrelevant, but it does allow people to say, well, you're funding this versus that, and that's not fair, et cetera. So this gets rid of all that.
Thank you.
And what?
Yes.
Just I was just reading the resolution that I guess is going to go to the board at a February meeting. We talked about actually making the change after fiscal year end, so the reporting is clean. So you'll get the approval, but the actual execution will be in April.
Yes.
Okay.
We're gonna let this fiscal year, because the RHC plan is on our fiscal year, so it ends in March. So we're gonna leave it as it is through March, and then we'll, assuming this is approved by the board, we would move to consolidate everything in April. So thank you, Jason, for pointing that out. Any other thoughts or questions? No? Okay, let's keep moving. All right, so the next subject is the investment policies for the pension plan and the retiree healthcare plan. The relevant statute, as Dirk alluded to, was Public Act 314 of 1965. This is the plan. This is the statute that governs what can and cannot be invested in, and with certain limitations. So the investment policies that I'm proposing, the change is to allow the plan to invest in all vehicles allowed by that statute and up to the maximum provided by that statute. And you'll see in the resolution that it literally says you can invest up to this based on Public Act, that actually uses the MCL, but it says it's that way. If the Public Act is ever changed, our investment policy would stay consistent with whatever the law is. And so the biggest modification is going to be allowing new asset classes, which are captured by Section 20D of the Act, which allows other types of investments called alternatives. This section allows us to invest trust funds in private equity, venture capital, hedge funds, among others. The statute allows a trust of the size of the pension trust to invest in no more than 20% of aggregate trust funds in alternatives. And the RHC trust, which is smaller, can only invest 15% of aggregate funds in alternatives. And I've asked Brian to give us a primer on those types of assets, why they're good, pros and cons, and why we might want to include them in the portfolio. Brian.
Great. So those couple of slides, they were tucked into the book. I pulled these out of what was provided in the packet as a larger primer on private equity and private debt. But I just wanted to take a couple minutes. So it's tucked into, there you go. It's 5 staple pages that were tucked into a larger book. So I had alluded earlier in the presentation talking about energy versus information technology and owning a diversified portfolio. The whole idea here is just like adding real estate to the portfolio was trying to decouple the success of the DB plan and the retiree healthcare plan from did the stock market go up yesterday or down yesterday, right? And it's just adding more opportunities. And specifically looking at and starting the education process around the idea of investing in private equity and in private debt. So the first piece is just looking from a long-term return standpoint and from a forecasted return standpoint, looking out for the next 10 to 15 years is, private equity is expected to generate kind of a high 9, low 10% return, which is more attractive than the equity market, than the stock market. And private debt or private lending is kind of high 7, low 8% return. Again, more attractive than fixed income. So we take you to the second page in, this is labeled as page 8, kind of defining the asset class. So I will tell you, for us as a firm and for me personally, the idea of private debt allocations is probably the most attractive asset class that exists in the landscape right now. And it's because we've kind of gone through this perfect storm from a banking regulation standpoint. If you go back 20 years ago and think about lending to businesses, 90% of that lending was done by banks, 10% of it was done by Wall Street. Right? So if you're a $500 million business and you need to borrow $50 million to acquire a competitor or a supplier or build out a new business line, you went to the local bank and borrowed the money. 90% of it was done by banking, 10% was done by Wall Street. That number is now reversed. Less than 10% of business lending is done by banks today. More than 90% of it is done by Wall Street firms. And why is that? Regulation changes, Dodd-Frank in 07, 08, as David alluded to, Silicon Valley, bankruptcies that happened early in 2023, banks are just walking away. We've heard of banks, we're now doing lane financing. If it doesn't fit in this exact lane, I realize you've been a customer of this bank for the last 50 years. You have a ton of money with us. You've been a great customer. You've paid back every dollar we've ever loaned you. It doesn't fit in these parameters. We're no longer lending. So these teams, these lenders that were on the banking side are now operating their own firms, and that's now 90% of the lending volume. And it's become a really attractive asset class because if you think about it from a pension standpoint, what do we need? We need cash flow to pay benefits. Well, a loan in its simplest form is I lent the money to someone. As they pay me back, I get principal and interest. That's the return I'm generating. So I'm not buying an asset, waiting for it to increase in value to sell it at some point in the future. I'm literally lending someone money, lending a business money, and as they pay me back, that's the return that's being generated. So when we talk about an 8% return, and I think that's kind of on the low end in the current environment, 90% of that is interest income, right? Think about the mortgage payment you make or the car payment you make. There's interest assigned to that. That's the profit that the lender is making from you. And there's a number of different asset classes. We tend to focus on kind of a little bit more of a simplistic approach, which is senior direct lending, and that is senior loans to corporate borrowers. From a personal standpoint, think about it like it's first mortgage, right? If you default on your house, your first mortgage, right? Your 30-year fix, your 15-year fix, like that's the first person in line in terms of being able to get to your assets. So it's being a little bit more conservative, a little bit more simplistic in that approach. But there can be mezzanine lending, there can be distressed debt, and then you can get into some of the more niche strategies where you've got asset-based lending or special situations. That's much more opportunistic. What we would work to build out here is a more traditional, more conservative approach where we're much more senior, right? It's first loan, first lien on any assets associated with any of those strategies. And for us, we focus on firms that have invested for 20 plus years, right? We want to work with firms that went through 07, 08. Like, show me how you've made loans before a recession to corporate borrowers and have managed through that process and have been successful in that. The other piece of it is, if you take a look at the third page, and if you're looking on a page number, it's going to say 6 in the bottom left-hand corner, but it's shifting to the private equity side of things. So if you think about it, from an institutional standpoint, private debt started maybe 20 years ago, but private lending has existed since humans roamed the earth, right? Private equity has existed as an institutional asset class since like kind of late 70s, early 80s. But the idea of investing money into someone's business for profit has existed since people roam the earth, right? This is not a new asset class, just from an institutional standpoint, it's gotten earlier adoption. Saying you're gonna invest in private equity is like saying I'm gonna go buy an automobile. Is it a car, is it a truck? Okay, what make, what model, what trim line? It's a huge, broad divergence. We have a tendency to focus more on broadly diversified funds, so not a single strategy, a variety of different strategies. Tendency to focus more on buyout. You can do venture capital, right? I've got a new idea, I'm gonna put money into it, and it's a binary outcome. It's either 0 or to the moon. Growth equity is more like successful business, we're gonna invest to help continue that growth. Buyout is, again, successful business, just going through some transition, and then turnaround or distress. I think of the example like Topps. Everybody that collected baseball cards in the 70s and 80s, like you bought Topps, right? Well, as that business has changed, that was a turnaround distress story. And either rental car companies, post-COVID, those were turnaround and distressed opportunities. I don't know if anybody's tried to rent a car lately, but if you can get it for less than $100 a day, it's an absolute steal. 3 years ago, you could get a mid-sized car for $35 a day, wherever you were flying to. So again, this is the idea of looking at different opportunities, more from a conversation standpoint, more from an education standpoint. These are all asset classes that are permissible under Public Act 314. And the idea is just broadening the opportunity set to make sure that the success that the defined benefit plan and the retiree healthcare plan have had, in their existence, that we can continue to have that success going forward.
Okay. Any questions on that for Brian?
I got one.
Oh, go ahead.
So you said you represent 30 other municipalities. Do other municipalities invest in these spaces?
Yes.
Majority of them, are we the outlier?
From a private debt standpoint, I would say like across the 28 municipalities that I work with, 24 of the 28 invest in private debt. The other 4, it's an ongoing conversation. From a private equity standpoint, probably a third. And again, some of that's based on size. I have a meeting tomorrow morning with an $8 million pension plan. Like it's just not going to work. But with a $100 million portfolio and savvy and knowledgeable, and that ability to understand how it works and how to process it, and the auditors understand it and everything else, it's an appropriate asset class.
Yeah, the thing I would add to that is keep in mind that in the pension plan, 57% of the entire trust is invested in a single fixed income asset that we have no control over.
Do we know what that's paying?
Yes, it's going to pay 3.85% this year. So for 2024. So that means that we can only invest the 43% that we have discretionary control over. So since we're only going to get 3.85%, which is a lot more than we got in a few years ago on that plan, I thought it made sense to introduce these other investments to try to enhance that overall portfolio return. And because we have 57% in a fixed income guaranteed, it's a guaranteed account. That's why we get so little return on it, because it is guaranteed by Prudential. That with the remaining 43%, we could take on some calculated risk and try to juice the returns a little bit. And so either private debt or private equity would allow us to do that.
And I think if I read it, you got up to 10%?
Yeah, so in the proposal for the investment policy, I proposed 5% for alternatives of the 40, so it's 5% of the 43%, which really comes out to about 2% of the overall portfolio. So we're not talking about, selling the stocks and investing the farm on private equity. We're talking about a tiny little, smidge of the overall portfolio, 2% going into these alternative assets. But on a $225 million fund, a trust fund, that's about $5 million, which is kind of what you need to get the attention of any of these, really good managers.
From my experience, I've seen it range up to 20%, right? And so I think that's a good way to get your feet into the water. It doesn't mean you're buying what he's going to propose. It just gives us the opportunity to. Right. So I think that's a prudent.
And it's similar to what we did with the real estate. When we decided that we wanted to get into that, we got into it a little bit, decided that we liked that market, it provided a diverse part of our portfolio, and then we upped it. I think we originally had gone even higher and then kind of tailored it down to where we thought it was a good value. So this would be the same approach.
Correct. And I think real estate falls under the alternatives anyways, doesn't it?
So under Public Act 314, real estate has its own section as a permissible asset class. Private debt and private equity fall under what's affectionately known as the basket clause. And that's the provision under Public Act 314 that says, if we haven't told you you can do it, or haven't told you that you can't do it, it goes here. Okay. And the premise is, like, Wall Street in its infinite creativity is going to create a new asset class, a new investment opportunity that legislature just can't move fast enough to be able to adopt it. We're talking about asset classes that have existed for 20 to 40 years, and legislature hasn't moved to be able to list those. But it falls under that provision. It's the basket clause.
That's 20% of the total trust, whereas I'm proposing 2%.
Yeah.
Right. No, I'm just telling you from experience.
Right, sure.
Can this fall under fixed income or not? The definition of it, or is it too finite to even? Because we have a fixed income allocation. This is lending now.
Yep. So the beauty and the curse of Public Act 314. Public Act 314 is for qualification purposes. It isn't necessarily for investment purposes. So for us, we think about it like, am I investing because I want it to go up in price, or I want it to pay me income? Private debt is fixed income because I'm not investing in an asset class to go up in price. I'm investing in an asset class to pay me interest. Private equity would go on the equity side of things because I'm investing in an asset class because I want what I bought today to be worth more tomorrow or a couple years from now, right? So any private debt allocations you would see listed under fixed income. Any private equity would be listed under equity.
But it falls under the basket of that 5% we're talking about,
correct?
2.5%.
Correct.
Okay.
Okay. Any other questions on that? I'm just mindful of time here. I want to move forward, but when we bring this to the board, we'll go in more depth about the investment allocations. But just to be clear right now, that my proposal in introducing this asset class is to allow us to dip our toes, as you said, Chris, and not sell the farm and mortgage it to go all in on .com stocks or something, or Bitcoin. Let me be clear, that is not my proposal. Okay, so let's move on to our last category of investments, which are our defined contribution plans. For these portfolios, we only provide options to plan participants who can then direct their own investment decisions. Rob Higgins of Schwartz & Company advises on these plans. So we've got 3 plans that fall into this category. The first one is the 401A plan, which is where the township makes a retirement contribution on behalf of active employees. The second is the 457B plan, which is where the employees make their own discretionary pre-tax contributions, or I guess it could be post-tax too, their own discretionary contributions, and that plan holds $31.4 million of participant funds. Thank you. And the last one is the Retirement Health Savings Plan, which is where current employees contribute funds into an account that will be able to grow and used for healthcare expenses in retirement. So basically, these defined contribution plans were all put into place after 2005 when the pension was closed, and 2011 when the retiree healthcare plan was closed. So these are all the newer employees, and this is their retirement benefits. And as I said, we don't direct the investment of these funds. All we do is provide options, and then they direct their own investments as to whatever they're most comfortable with. So, Rob, take it away.
Yeah, thank you. Good morning, everybody. I've got 14 pages that I've tagged out of this deck, so don't fear the thickness of the book that you're looking at. I'm going to take us immediately to inside the tab 2, page 10. So as Michael was describing, these are participant-driven accounts, and Schwartz & Co., I view my role, our firm's role, first and foremost, is to be available to the participants, the employees of the township, serve as a resource, help them with investments, and not just specific to their own 401A, 457, but their whole financial wellness, whether it's budgeting, debt payoff, etc. So what you're seeing on page 10 is just a recap of activity that took place specifically in 2023, just as recent as yesterday. On a conference call with Empower. Jason was part of that, and we're going to game plan out what 2024 looks like, talking about more financial wellness opportunities, on-site meetings, et cetera. So we'll build that out in the near term here, and I think what I want you to know is that I feel people have a pretty good idea that they can contact me specifically as the point and meet anytime. It seems a week doesn't go by where I'm not at least meeting with one individual in person from the township. So I think there's a good relationship there. I hope so. And if they don't like me, they can work with a team that I have as well. So on page 13, I inserted some slides that are from a report that Empower provides, more of a planned demographic trends report. So I just want to let you know that the full report is available to you, Michael. We sent that to him. These are just some select slides. I wanted to highlight on the left side of that page, average balance. This is in the deferred comp plan, the 457. So this is an optional plan that people can participate in, not funded by the township, only funded by participant deferrals, and a good average balance in that fund, in that plan. Page 14, a whole bunch of statistics on this slide. I just wanted to draw your attention to the third row, far right, average contribution rate of 11%. You know, that I'm mindful of those stats and always trying to encourage. I'm not tone deaf though. I'm not force feeding. You got to be at 10, 11, 15% and someone's struggling paycheck to paycheck. But this is a great data point in terms of long-term trends and, you know, the health of savings rate within the township. But that's very healthy. And again, that's just specific to the 457. More of the same type of statistics on page, in the following pages, and these are specific to the 401A. So, for instance, on page 17, you have the average balance highlighted there, and then page 18, additional statistics, usage rates, etc.
Quick question. To do-it-yourselfers is like 50-50 versus 80% of the other one. Is there a reason why?
Yeah, you're talking about on the 401A?
Right.
Yeah, we noticed that in looking at these statistics. That kind of surprised me because out of the hundreds of meetings that I've done, you know, I'm never, rarely am I directing people to target date. It's an option there. We're going to dive into that a little bit just to see if there's any anomalies, but if you would have asked me before looking at that, my impression would have been the 401A is heavy in favor of do it myself, including my, you know, input on that in terms of a tailored portfolio. So,
Can you explain maybe what that means, do it for me versus help me do it?
yeah, do it. So if a participant logs into the Empower website and they say, well, I want to choose my investments, there's a pop-up screen that would say, need help? And if they go down that route, they'll be guided towards target date funds, which are age-based, kind of set it, forget it. Do it myself gives them the opportunity to pick individual funds, hand pick, et cetera.
And the do it for me, which is a very small percentage, is a service
yeah.
that Empower offers that costs money. We don't pay for it, the participant pays
That's
for it.
That's exactly right, and there's been some discussion that we've had behind the scenes this whole entire year of Empower, you know, how overtly are they trying to capture an audience, and we've been very vocal with them, I can tell you, and
yes,
we've turned off solicitations in that regard. But nevertheless, there are a handful of people that have opted into that do it for me, and as Michael had mentioned, Empower, for an additional fee beyond the cost structure of the plans, will allow people to fill out a risk profile form and essentially diversify their portfolio for them. Candidly, I don't see that as a value add if they're willing to, you know, talk to our firm or me. That's what we're on board for. Money. We're built into the cost structure.
The cost structure, right.
And so whenever I am working with anybody and I notice that they are into that type of program, I just want to make sure they're aware. And in several cases, I've helped them opt out of it. You know, hopefully providing them some cost savings.
Yep.
There was definitely confusion in messaging. You know how vocal I was that
yeah, no,
it wasn't even explained at first that there was a cost. Then when they did, they made it sound like we were forcing that direction and you were going away. So
yeah,
there was definitely some discussions.
We're not the only investment firm to be a little disgruntled because, you know, Empower, they're coming out saying, we'll manage your money for you, and all of a sudden we're advisors too, right? So the guys in our wealth management division, other firms, you know, we've all had a pretty big voice in that regard. Now, one interesting point, out of all of the confusion last year or kind of tension points, one good element, Elizabeth Parrott, who runs Point on the administrative front, Empower, squeaky wheel gets the oil. She's been invited to sit at this at the table for the government plans at Empower, and she's on a consistent meeting schedule where she gets to voice her opinions on matters, and she's an end user, and she's front and center in terms of, hey, this is how this is being perceived, and we need to change this. Just yesterday, something as simple as how a notification can be turned on or off, and she voiced that, and she's going to make that an agenda item at the next meeting. So she has a very prominent seat at the table in terms of being a change agent. I think that's good for the township, being an advocate. I'll dig into that target date question. That I take pride in being able to work with individuals one-on-one, and I don't want you to ever feel like it's just, hey, go on a target date.
Yeah, that wasn't implying that.
Yeah, no.
It doesn't make target date funds, you know, a bad thing. So, you know.
Yeah, sometimes they're a fit.
It jumped out compared to the two plans.
Yeah.
I would just add to Dave's question on that. The 457 plan is much older. It goes back to before the 401A even existed. So a lot of the people that have money in a lot of the people that have defined benefit pension also put their own money as a supplement into the 457. And then, I mean, that goes back decades and decades before the 401A was created. And so if you look at the participants in the 401A, they're much younger. They may not have, or they don't have the defined benefit pension, and they may be also supplementing into the 457, but two kind of different populations.
Is the default the target
Yeah,
date? So
that's the one,
right.
What I can mention is if as individuals on board and at the township, they're immediately defaulted in that target date, and so it takes a proactive move to opt out of that. So I think some of the data there might be inflated a little bit, because if I'm working with somebody that's been here a few months, they may have a balance in that target date, but we unwind that eventually and move it into more customized portfolio.
Thank you. That was perfect.
Let me move to inside of tab 3 on page 25. So this is a slide that essentially rolls up the assets in the 457 and 401A combined. So I'm on the lower right column. In total, just north of $50 million in plan assets as of the end of the 2023. And then the box score down at the bottom, you'll see inflows and outflows, as well as net market appreciation that took place last year. So healthy market, nice capital appreciation across the board. Points of interest, if you go down the far right column and about midway down, you'll see 19.1. That's 19.1% of plan assets concentrated in the JP Morgan large cap growth. So it's not a surprise that large cap growth occupies a high concentration of the plan, but that's a very technology heavy, over 40% of a technology exposure in that portfolio. So I wanted you to know I've been mindful of that in situations where people might, it feels good on the way up, it can feel doubly bad on the way down. So anytime there's an opportunity, if someone's overexposed to that type of fund, high octane fund, pick my spots in terms of walking them back a little bit. But good asset allocation across the board.
Rob, can I stop for a second?
Yeah.
The top two rows, guaranteed interest fund and a guaranteed fixed fund.
Yep.
Those are just marked fixed rate. Are those similar to the GDA that we have?
Yeah.
So basically, you guarantee some interest every year.
So the guaranteed interest fund is a predecessor fund, legacy fund, if you will, closed to new investors, locked in at a 3.5%, and the only activity that takes place is liquidations out of that fund. No new investors, no trading in and out, and then the Empower's guaranteed fixed fund essentially fulfills the cash equivalent option for investors in the plan. So provides daily liquidity. People can move in and out and serves as the most conservative investment option in the plan. So $3 million in that what we'll call legacy fund, not uncommon for individuals older, have the pension, especially those in a higher risk career, i.e. police and fire. They opt for that conservative sleeve and they just set it, forget it, and they just want to know that it's there when they retire. So there's case by case, if I see a balance that, or someone that could potentially benefit from a reallocation, I certainly pick my spots with that, but I'm mindful of their lens of life too. Okay.
And just as a visual, if you look at the bottom, the target date funds kind of answers your question. They probably got in there in the beginning because it's like 9% of the portfolio.
Yeah.
Maybe 20 on the 401. So it's weighted from a percentage of participants, but it's not as assets.
Yeah.
So you're doing your job.
Well, I'm sweating profusely after getting drilled by you, Dave. So.
No, I was curious.
No, just kidding. No, that's good. That's good conversation. We notice the same statistics. Let me advance to page 28, and I want to provide you with essentially what this is an all-in cost analysis of the plans, 457, 401A, and so on a weighted average basis, if you move over to the right side, far right column, and you go down, you'll see 38 basis points. That's the all-in or that's the weighted average investment cost. So the expense ratios of the fund on a weighted average basis, 38. 17 basis points, our annualized fee. We're on an incrementally declining fee schedule. Last year that was at 18, so a tick down. There's economies of scale as assets grow. And then Empower's record keeping costs fixed at 6 basis points. So I can confidently say that on a weighted average basis, the weighted average all-in cost for participants is 61 basis points. And so far less than 1%, and there's good value there for sure. It's a very cost-efficient plan, and I've got some benchmarking data in a couple slides, but before we get there, I want to take you to page 29. Sorry to turn it's portrait. Michael and Jason have been working with Empower behind the scenes to proactively identify some cost savings, and somewhat similar to your conversation about consolidating the retirement health sub-accounts. Within the retirement plans, there's opportunities at times for certain funds to move to a collective trust or a separately managed account version of the same fund. Essentially, it's the same fund offered at a lower expense ratio. And the reason for that is it's specifically offered to funds that are within a retirement plan, so a lot of cash inflows, not a lot of cash outflows, so cash flows are managed. Portfolio managers can stay more fully invested. They don't have to carry a higher cash balance within their fund to fund liquidations. Marketing fees that are built into an expense ratio don't exist because these aren't retail funds to the average shareholder. They're just specific to retirement plans. So in a nutshell, that's the working definition of why these separately managed accounts or collective trusts can be offered at a lower expense ratio while offering all the advantages of a diversified mutual fund. So in 4 cases, there are some opportunities where Empower can just slide from our existing share class into the lower cost option, 2 of which are available now, and Michael will be signing some paperwork to affect those. Highlighted in the middle of the page, JP Morgan, which is the highest concentrated fund in the portfolio. Took a blind look at the expense ratio. Currently it's at 44 basis points. So this is reflecting that with this move it goes down to 41. So it's not a windfall, but it's savings nonetheless. And then the other live version that's being offered currently is the Euro Pacific Growth, which currently is 47 basis points, and again after this move it'll go down, expense ratio 41. My effort here was to quantify, well, what is that if we take advantage of these cost savings that are more or less a slam dunk. Again, it's not changing the fund, it's just sliding to a different share class option. It equates to just under $6,000 a year, but every penny matters in terms of participant returns, et cetera. So that effort is going on behind the scenes. I just wanted to let you know. In terms of benchmarking, the cost structure of the 457 401A plans on page 30. Top of the page, you'll see the average and weighted average costs for the plans, 57 and 61 basis points respectively, measured against 2 universes. I chose a data point from $50 million plans with $100,000 average per participant balance, and then I even brought in $100 million plans with $100,000 balances. And happy to report, under both those circumstances, you're well under those benchmarks. So from a cost efficiency, and I've shared this page with participants too, just whenever I'm in the weeds with conversations and everyone's cost sensitive, I'm happy to kind of get into this type of detail with people that don't want to fall asleep on me. It's not the most exciting stuff, but it's important. On to page 31, retirement health savings plan. Bottom right, you'll see that this plan is north of $5 million now. And I wanted to highlight that because of what you'll see on page 32, which is the cost structure of this plan currently. Under the current contract with Avabin, who is the administrator, again, this is separate and distinct from Empower, so it's a standalone plan. It has a different cost structure than the 401A 457. It's a startup plan. It started at 0 assets. It's growing. Avabin's initial annual asset base fee was 76 basis points, 0.76%, until we reach this critical $5 million threshold where they're moving it down to 56 basis points. So again, that's just behind the scenes move. Michael will execute that paperwork for an amended service agreement, but that's considerable cost savings. So that's really good news there. And I just showed you a projection down at the bottom, a 19% reduction to estimated total plan cost, just with that one move is what we'll capture. And in terms of benchmarking the cost structure of that retirement health savings plan on page 33, again, Bloomfield Township up at the top, $5,022,000 average per participant balance, and I measured it against plans that are $5 million, $10,000 per participant average balance, and $50. So on a standalone, you're right there at benchmark, but certainly after this move, you'll be very price efficient relative to these data points. So that's good news. The remainder of that section, just a couple pages, is relative to the 529 plans. I'm going to leave that for your review just in the interest of time. I want to move to tab 4. On the investment benchmarking, I always reiterate this every year, and I think it's an important point that we're just not chasing performance, and the effort isn't to show up here and if a fund is lagging benchmarks just to change just for change's sake. Sometimes having some exercise of patience, letting a fund breathe through a market cycle is important. So on page 37, 38, you'll see the entire fund lineups available. The reason there's 2 separate pages is the retirement health savings plan based on size of the plan and assets. Certain share classes are different. And again, that kind of syncs up with what you were talking about with consolidation of the retirement health. So consolidation, economies of scale is a good thing. When we go through the granular exercise of fund by fund analysis just to ensure that we've got a best-in-class fund menu available to participants, that is what you see reflected on pages 39 and following, the remainder of this deck. I'm not going to go page by page here, but I did want to just draw your attention to page 52 as a marker. Again, I remember for some reason it stands out. I was looking at Martin when we did this exercise last year. It feels like Groundhog Day, but I wanted to just show this exercise of what we're doing on a fund by fund analysis, or just to give you an idea of what we're looking at, body of work of a fund. So you'll see assets listed in this fund, both in the 401A 457 and the RHS. So 19.1% of plan assets, again, highly concentrated in the 401A 457. The first row of data is the fund. You'll see return information and risk measures, PE ratio, holdings in the portfolio. That's a misnomer. That should be right around 79 holdings in the JP Morgan large cap growth. For some reason, Morningstar imported the wrong number there. Management tenure, expense ratio. So we effort to show the body of work of a fund relative to category, row 2, relative to an index, row 3. Provide you with quintile rankings, which is basically a raw score of how the fund stacks up to category on raw performance, and then a sector analysis. No surprise here, like I mentioned earlier, if you go to the 4th column from the right, technology, 46% of the portfolio. Magnificent Seven are certainly represented in this type of fund. So with this type of analysis, and there's nothing wrong with this fund. This has been doing a good job for investors over a long time, but I just wanted that to serve as a kind of model case of what we're doing on a fund-by-fund basis. One recommendation we are making at this point on page 63, it's specific to the Emerging Markets Fund, and it's certainly not a heavily concentrated fund, 1% of assets in the 457 401A. If you look at the quintile rankings, it's still holding on to a third quintile, so it's kind of right in the middle of category on a long-term 10-year basis, but certainly underwhelming in a 5, 3, 1 year. Emerging markets has been a tough asset class regardless over the last 5, 6, 10 years. There's some qualitative factors here. The management team, they've been taxed with not only managing this fund, but they're also, I think, to put it politely, spread a little thin in terms of oversight on other strategies within American Century. So maybe diluted focus, my thoughts. I listed for you in a gray shaded a row, you'll see DFA emerging markets, and a couple material facts here. Number of holdings in the DFA emerging markets, it's over 1,800 holdings, so it's a very, very, very broad-based exposure to emerging markets, and more importantly, doing so at a very extremely thin expense ratio, so very low costs, and offering, at least from a historical basis, solid returns, net performance relative to category. No crystal ball in terms of what's going to do the same going forward, but with that type of broad-based exposure and low expense.
Do we have to put that on a watch list to remove it?
We had it on a watch list. Okay. I elevated it, and normally that is the cycle I prefer. Rarely would I just see, unless a fund management team just blows up and there's a material reason to just all of a sudden move out of a fund. Normally I like the exercise of at least moving it to a watch list, having some patience, just pacing it a little bit, and but in this particular case, I think just seeing some cost savings on the table too, added to the elevating it. Right. To that point on page 69, just under last page, thank you for hanging with me. Summary recommendations. Michael, to your point on the middle of that page, or on the top half is basically, I listed the funds that I would say, hey, they check the box, performing as expected, better than. In the middle, watch list, removing the global fund, remaining on watch, high yield bond, and then under fund change actions, the American Century's replacing it with the DFA. So parenthetically, I just wanted, or in italics, you'll notice I wanted to just see, so when we say remain on watch under Lord Abbett High Yield, I wanted you to know, well, how long has this been on watch? Has it been on watch for a decade or 5 years? So we just elevated that last year to a watch list, and so it's not stale by any means. But
do you think both of these need to stay on the watch list? Is your recommendation that both of these stay on the watch list?
I'm suggesting that Lord Abbett stays on the watch list, and American Century is outright replaced. Right, so that's the one fund action that I'm recommending today, and certainly don't need an answer. Right. And again, really try to pick our spots with moving in and out of funds, but given that it's 1% of plan assets too, it's not going to move the needle a ton. But I just trying to do what's right by the participant.
Sure. Any thoughts on that, and then we'll wrap up.
Just one question, when you do replace a fund, it takes a couple quarters, doesn't it, or is it?
Yeah, normally, there's disclosure notification that has to go out 30 days in advance. That's natural lead time, but then just in terms of getting in the queue of Empower, so normally if we said go, generally 90 days.
Okay.
Ish. Yeah, so it's not immediate by any means.
Right.
Any other thoughts or questions?
Oh, thank you.
Yeah, I really appreciate everybody's time.
Thank you.
Good seeing everybody. All right.
Thank you.
So the investment policy for the DC plans has been the same for a while, and I don't feel there needs to be any changes now. It is included in your packet since we technically have to review it, but I don't believe that. I think it's fine the way it is. Does anyone else have any thoughts on that? Okay, then let's move on. Item 8 is new business. Does anyone have anything that needs to be addressed at this time? No? Okay. Moving on. Item 9 is to set the meeting dates for the rest of this year. Typically, we followed a pattern of being the final Wednesday of the first month of a quarter. Brian from ANCO has requested some additional time to get data following the end of a quarter. So I'm proposing that we move them to the Thursdays, either the first Thursday of the second month of the quarter or the Thursday right before it if it's toward the end of the month. So I'm proposing Thursday, May 2nd, Thursday, August 1st, and Thursday, October 31st. I've already checked the suit.
Are those the same week as a board meeting, or those are off weeks?
Those would probably be off weeks.
My preference would be the same week as a board meeting, but
That's right. Reduce the amount of vacations, because like we have a vacation issue right now.
Right.
Typically, people stay in town during board weeks. We had one this
Well, but remember, this is not the full board. This is just the FSC.
Oh, that's right. Okay.
Good point. Just this meeting then, which is
Correct.
not a board week yet.
Only once a year do we have the full board.
annual one.
The annual one.
Yeah.
These 3 meetings are just the Retiree Healthcare Trust, which is Chris, myself, and Jason, and then the FSC, which would be Neil, Raina, Dave,
and from my staff standpoint,
and Neil. Did I say Neil?
Yeah.
And Jason.
right.
Right.
And from my staff standpoint, we support the meetings, and one of the 2 people who can do that will be present and
Right.
help with that.
Do any of those dates?
Yeah.
New primaries or?
I mean,
No. We actually looked at if we kept it as the first Wednesday of the second month, they would be the mornings after the election night.
Yeah, that'd be rough
So
for you guys.
I suggested that we not do that. So I'm going to propose right now, if anyone, I'll leave it open for a week or so, anyone to look at their calendars and confirm that there's no conflicts. But we'll propose Thursday, May 2nd, Thursday, August 1st, Thursday, October 31st. The RHC Trust meeting will be at 7:30, and the FSC meeting will be at 8 o'clock. All right?
they are, by the way, just before the election days.
Correct. Okay, I would also like to acknowledge Mary J. Baharian, who's the new Deputy Treasurer, who is nice enough to sit in today, and so I didn't acknowledge her earlier, so I want to do that. I'd like to thank everyone for coming, especially Dirk. He doesn't normally come to these meetings, but I wanted him here to be able to talk about the investment policies as it. So if there's anything else, then I would look for a motion to adjourn.
So moved.
Moved by Chris. Any support?
Support.
Support by Supervisor Walsh. Without objection, that motion passes.